So in this video, I want to talk about the lie developers believe about investors. But before I get into it, just want to give you a quick bit of context. I spend most of my time working inside active capital raises. That means I work with developers, I work with operators who are actually in the market trying to raise money, raising money every single day. So this isn't based on theory. This isn't people planning to raise money. My team and I literally do this every day. We raise money every day for these different sponsors, founders, operators, developers, all sorts. So what I'm talking to you about now isn't really based on opinion or something I've read on the internet. It's really experience and patterns that I see over and over again. And one of these things, this lie that I'm about to share with you, quietly destroys is otherwise be a good looking raise. So if you're thinking about raising money, if you're actively raising capital right now, this may be something you want to listen to. Furthermore, to give you some context, just so you understand where I'm coming from, I've actually been on both sides of this whole capital raising business. I've done it since 2010. I've raised capital successfully, large companies, massive capital raises, even small companies that have grown to be very large over that period of time. But I've also seen when things go wrong too. I've seen when incentives break down, when structure breaks, when bad actors are involved. I've lived through some consequences resulted in failed raises, consequences that have been extremely severe for me and other people involved, where capital has been raised the wrong way, especially when there's bad actors involved. So that overall experience has really changed how I think about investing, investors, capital raising as a whole. From an integrity standpoint, I'm going to share with you what I've learned up until now. This lie that most developers believe about investors, what is it? Well, they think investors are rational. That's the lie. They think investors make decisions primarily based on numbers, logic, spreadsheets, IRRs, internal rates of return, that sort of thing. And because of that belief, developers spend most of their time trying to prove the deal. I mean, why not, right? They're buried in those same spreadsheets themselves as they're building out their business plan, right? They're making sense of the deal for themselves. Is this going to work? And when it comes time to speaking to an investor, of course, what they want to do is they're sharing all of that data. They're sharing that detail, that explanation. They're forcing themselves to do thinking that's what's going to move the needle when it comes to those conversations with investors. But that tends to be where things go horribly wrong. Not horribly wrong, but just generally you don't move money as quick as you want to. Because ultimately investors, they're not rational decision makers. In reality, they're risk managers and they're focused really on what can go wrong. And those are not the same thing. So most developers believe investors are asking, is the deal good? Are the returns competitive? Does the math work? They respond naturally with tightening up their pitch deck, polishing up their pro formas, adjusting their returns, adding more pages to whatever documents they're trying to share with them. But what the investors are really asking is, can this person hurt me? Is there something I'm not seeing? What happens if this goes wrong? Do I trust the way this has been thought through? And those questions or answers to those questions never really appear on a spreadsheet or those documents. And the more a developer tries to prove the deal, over-explaining, providing more information, the more investors tend to start looking for what they're missing. Investors don't decide based on upside. Upside will get them interested, will garner attention, but they actually decide in terms of when money is being moved. They're deciding based on downside containment. And what that means, how protected they feel if things don't go to plan, if things don't go perfectly. Your returns will attract attention. Having high returns, having a good looking project, that's going to get attention. But it's the risk profile ultimately that determines the action when it comes to an investor moving money. And that's a difference a lot of developers miss. The more information you give an investor, the more surface area you're effectively creating for doubt. There's more chances you give them for finding something that they don't like. I've seen this time and time again. When I'm just talking with my own sales team, when they're speaking to prospective investors, they think everything's going well. These guys are asking for all this sorts of due diligence. They want pro formas, they want P&Ls, they want audited accounts, and they're asking nonstop more and more questions because they think the investor is really doing their due deal. But what's happening is the investor's not finding the answer to their question, their burning question that's deep down inside that they're probably not voicing, which is, how can I remove uncertainty from this deal? The more information you give them, the more chances you're giving them to find something that they don't understand, don't like, dots they can't connect. More slides doesn't necessarily equal more trust. More spreadsheets doesn't garner that trust either. So more often than not, they end up doing the opposite. However, when a deal is clean, when it's structured, when it's well positioned, it doesn't need defending like that. When you feel the urge to over-explain, that's usually your signal. It's usually because something hasn't been resolved. It hasn't been resolved upstream. Something hasn't been dealt with before your pitch deck ever went out. Investors will feel that immediately. They might not say it, but they'll feel it. And this is what you have to be tuned in on. Let me give you a real world example. A developer sends an investor a deck. It's 40, 50, sometimes 60 slides, maybe more. They have every scenario in there, every sensitivity point covered. They've got every contingency outlined in there. Now, they think they're being thorough. They've got all the financial financials in there, reams and reams of pages of just data. But what the investor's experiencing is a little bit different. They're thinking, wow, this is really well put together pitch deck, but what am I missing? Why does this need so much explaining? Why are the micro factors being covered in such detail? And then they hit the slide that says, well, if this happens, here's plan B. If that happens, here's plan C. If this happens, then here's X or Y. And suddenly an investor doesn't really feel reassured at that point. They're alerted, right? They start looking at, well, what have I missed, right? Because they're now thinking, which of these should they actually be worried about? Which risk am I supposed to notice here? All these risk disclosures, right? Which one's being buried here in the fine print? It doesn't mean that everything in the deck is wrong, and nothing in the deck could be wrong at all. It's really just where the signal changes and the way an investor feels changes. And that's what you need to stop or try to mitigate. The deal stops feeling inevitable. And if it doesn't feel inevitable, what's the opposite, right? The investors are going to start being defensive. They're going to start asking more questions. And when that happens, it's not necessarily that you're going to get pushback from the investor. You're not necessarily get a no straight away. What you'll usually get is, thanks, great information, really appreciate it, let me think about it. We don't like that. That's when a deal's about to kick, when it's all about to go wrong, where you're about to lose traction. This is really down to uncertainty. The sense of uncertainty that sits with the investors, what they're going to do is buy time to think it through if they're going to make a decision, or buy time to essentially just say no without having to say no. So here's how most investor decisions actually happen. First, do I feel safe engaging with this? Then, do I trust the operator and the structure? And then and only then do the numbers make sense. So it's kind of in reverse order. And most developers reverse that order, right? They're doing it the wrong way to begin with. They're starting with, do the numbers make sense, and kind of flooding the investor's world with that, and then hoping everything else will just fall into place. But what they need to focus on is, do I feel safe engaging with this? Do I trust the operator? Focus on that first before you then put in the numbers, so that the investor can make a justifiably logical decision to pat himself or herself on the back when they actually take the plunge. But they need to feel comfortable with you first. And that's why when developers lead with reams of data first, they'll get interest. High returns, lots of info. Genuinely, investors will be interested, but you're not really getting as many commitments as you'd like out of that the way you'd want to. So when investors hesitate, it's rarely about returns. It's about uncertainty that they just can't justify. So they delay, they wait, and they'll ghost you, which is horrible. And we know that feeling. But there's also another layer to this. Developers are builders. They're operators. They're problem solvers. So when an investor hesitates, the instinct, of course, and I understand this because I've been a developer, is to fix the deal, change the terms, increase the returns, add explanations. But hesitation doesn't come from these things. You think that you're making these changes to enhance the probability of a positive outcome, but really, it's not a problem that sits with the pricing. It's not a problem that naturally sits with the documentation you're providing. It's usually down to a confidence thing, and the confidence won't come from just sending more information. Confidence is built by persuasion. It's built by structure. Here's how I think you should be thinking about it. Your job is not to convince investors your deal is good. Your job is to remove any reason not to invest. So that's the reframe. That's the lens you need to start looking through. And what that means is you want to focus on clearer positioning. So when someone looks at this, they're immediately understanding what it is, where it sits in their world, in their market, in their portfolio, and they're even being shown it without having to work it out. They can see everything, how it sits in their portfolio, where it sits in the market. They can see everything that's relevant to them without them having to figure it out, like to overly think about how this is going to work out for them. You're going to have in place a disciplined structure. So the risk is handled by the way the deal is set up. It's not with you kind of overly explaining and talking about the micro factors on a call. You want that to be self-evident. How is this structure going to handle the risk that I'm concerned with? And of course, you want to have a control of your overall narrative so that investors see the deal in the order that you intend, instead of jumping ahead and misreading something, connecting the wrong dots, and then suddenly just going quiet on you and ghosting you. And of course, you want to have that visible momentum so it doesn't feel like they're the first person who's jumping into your opportunity and nothing's going to happen without their investment, right? They want to feel like they're jumping onto a moving train in motion. They can kind of hop on and hop off. There's other people in. You can benefit from that herd mentality. If you've got those things in place, investors don't need to be sold as such. They kind of self-select. So you're really focusing on strategic positioning as a whole and getting your opportunity positioned. So in such a way, they're selecting you. They want to work with you. And that's ultimately what serious investors expect. The lie isn't that investors care about returns. They really do. The lie is thinking that what drives the decision is that information, that overly explained stuff. Investors only move when uncertainty is removed, not when upside is explained better. That's not what you need to focus on. If this is helping you rethink how you've been approaching investors lately, I'm actually building a small group for developers who want to fix these issues before they get back into the market. It's just a wait list right now, but if you want to get notified for when that opens opens up, there's a link in the description below. If not, no worries. Hopefully this framework could have changed, should have changed how you approach capital raising. So just to leave you with this, investors aren't rational, they're cautious. Cautious first before rationality kicks in. So if you focus on that, if that's the lens you look through, build for that and capital will move.